Good afternoon, TGIF. Welcome to Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at MarketSite is my partner in crime from the Weekly Markets Review, Chris Dearborn, is the Managing Director of Nasdaq's Markets Intelligence Desk. Chris, thank you as always.
Thank you, Jill, for having me.
It's the best day to be on, the end of the day on a Friday, and it's been quite a week in the markets. But before we get into the news that's moving the tape, let's talk about something a little bit more digestible, like non-farm payrolls this morning. The headline number was a bit of a disappointment, but I think people are looking at wages.
Absolutely. So we came in much lighter than expected, just 103,000 jobs added versus 185. Though you had that huge number for the previous month, which was much higher than expected, and they actually ramped that number up a little bit. So what you're looking at really there as a holistic point of view, a pretty stable environment there. People are back to work, and more important, like you said, the wages are holding steady. You know, you had an uptick from February there, and with that, you're showing consistency at about 2.7% year-over-year growth. And really with that, you're seeing money be put back in people's pockets. And a lot of those jobs are the lower paying jobs, which is good because those are more the consumer spendable names. Remember, GDP is based off consumer spend here in the U.S., and putting more people to work with more money in their pocket is a good thing.
Right, you also noted in your notes as well that March typically is a month that jobs numbers struggle. How do you think that this could potentially impact the Fed for the next rate decision in May?
Well, again, that's an interesting point of view, because what you have there is really a wait and see type of mentality from the Fed. Is Powell going to have time to digest this? And the answer to that is yes. The next Fed meeting is not till May. There is no April meeting here. And the expectations of the Fed actually raising rates for the May, it's only about 25%. Really got the June meeting on target as a 75% probability of a rate hike coming into it. And that can hold, the markets close to 3, which is where the expectation is, to possibly 4 times. So then you have an inflation question there. So it's a wait and see type of mentality for the FOMC, and to see what other data comes in. They want to digest this March, see if there's a revamp come for the April non-farm payroll and number, which will encompass this, and see how they readjust for last month, if it's a raise up or not. I mean, you have weather and a few other items been blamed on this. I know we're all done with weather up here in the Northeast. I am done with winter.
Yes.
I don't know if you are too.
See snow on the ground this morning was disappointing, but let's move on to the news of the week, and let's pull up a one-week chart on the S&P 500, because volatility is clearly back. We're seeing in equity volumes, we're seeing in clear derivatives. OCC put out their report this week that the first quarter of 2018 was the strongest in terms of record volume. So the market really is sensitive to this volatility, and we're seeing it in those volumes.
Absolutely. So volume has been excellent for 2018. You've seen higher trading volumes as a whole across the United States, and that's really going well for the trading firms. Vol traders are back in business right now. You're seeing multiple miles driven, or the breadth of the market on an intraday basis, 2, 3, 4% moves on multiple days, with great volume, not just from February when the talk of inflation came back, but with any type of rhetoric coming out of the White House on any types of tweets about trade war or tariffs coming, and then coming back from China and other places about that as well. So traders don't like fear, and investors don't like fear, but what fear does is brings volatility back to the markets, which brings volume back to the markets, which brings opportunity back to the markets for all those players.
I think it's really interesting how sensitive the market is to macro headlines, and this kind of always happens with that 3 to 4 week lull in between earnings, where it's just really a vacuum of corporate data, and the markets just really seem to tune in to what's happening from a macro perspective, particularly when you have your president pretty aggressive with tweeting, talking about trade wars, talking about potentially hurting companies that have been moving the market.
Right. So what he's doing, really, we've talked about this on the Market Intelligence Desk a few times, is that he's just basically checking off every box, every campaign promise that he made, he's bringing up. Whether it comes to fruition or not is irrelevant, but he's doing everything that he said he's going to do. So you shouldn't be surprised. The question is what the outcome will be. Is it a negotiation tactic for these trade wars, or is it really something that tariffs are going to impose and impact the U.S. economy and then the global economy more broad? What we're looking at here is, it's a day-by-day basis, but the market reacts to these day-by-day macro events. Remember, when you're looking at trading, you're looking at macro, you're looking at sector, and then stock-specific. And the macro is definitely in focus right now. We'll get the earnings season coming up soon. That'll be more stock and sector specific, and the outlook there is pretty rosy. Nothing's fundamentally changed. The economic picture is relatively good and intact. The non-farm payroll today number was excellent. Unemployment is at historical low levels, and people are making more money year over year.
Right.
So things aren't bad. You know, you had an unbelievable run in the markets from the presidential election until January, and now we've seen some volatility. We've taken a step back, but what's going to get us there next? Once the macro rhetoric gets through with that, it comes down to earnings.
Well,
and we're
traders
looking
wanted
for that.
volatility and it's back. So
We got it. And look at the VIX.
But it's kind of a shock going from 2017. It was from the bottom left to the top right of the chart. Not even 1% moves. Traders wanted volatility back, but even to see 400 or 500 point swings in a session is a little bit shocking when you haven't seen it for the past 18 months. But to wrap up here, let's talk about earnings. Financials, for example, you cover some of the financials. Trading in line with the S&P, even though you would think it might outperform due to deregulation and interest rates. So I think we're really going to get true color there when they kick off earnings next Friday. I know that's something you're going to be watching.
Absolutely. So two of the sectors we've been we focus on all the sectors here at Nasdaq, but two of them that have really outperformed so far this year are still tech and consumer discretionary. Those two sectors have been well performing. Even consumer discretionary coming into the all important Q4 selling season for those retail names has seen strength. So those two sectors are actually in the green for this year. I'd like to see how that's going to play out. And financials on the back of the interest rate hike should expect to see some bump there, but we're really not seeing mortgage rates really raised as high as we thought they would. So you're kind of concerned about where things are going to be. It's, again, a wait and see type of attitude, and we'll wait for the earnings to come out to see how things react.
All right. Well, thank you very much. We'll be back next Friday on April 13th. So Friday the 13th, which should be interesting. Curious to see how next week goes. Thank you very much, Chris and traders. Thank you for joining me throughout the week. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.